Welcome back to the Global Ledger. I'm Justin. Over the last couple of days, I've seen the same claim kind of everywhere. The Fed is turning the money printers back on. It's kind of spreading fast. It sounds a little alarming, and it feels familiar. But I want to slow this down and be very precise. This is not what just happened. Not mechanically, not operationally, and not in the way people think that phrase means. So in this special edition, number 5, we're going to walk through what the Federal Reserve actually did, what it actually said, and why this moment is being misunderstood. Let's get into it. Let's talk about what the Fed actually announced. The sentence everyone is reacting to, I think, and misinterpreting, is coming directly from the FOMC statement. And I'm going to read it word by word. Got it here. End quote. The committee judges that reserve balances have declined to ample levels and will initiate purchases of shorter-term Treasury securities as needed to maintain an ample supply of reserves on an ongoing basis. End quote. Okay, that single sentence I have seen is being translated online as QE is back. And that translation is wrong. And I'm going to talk about this. Ample reserves, that does not mean printing money. The Federal Reserve today does not operate by making reserves scarce. Its job is to keep the system functioning smoothly by making sure payments clear, funding markets remain stable, making sure short-term interest rates stay inside their intended range. When reserves start to drift toward that lower bound of what the system needs, the Fed steps in before stress appears. This is really maintenance that they're doing, not stimulus. Think of it like keeping enough fuel in the tank so the engine doesn't stall. That's very different from flooring the accelerator. But let's talk about what actually changed at this meeting first, okay? We're going to be specific. Number 1, the Fed lowered its policy rate by 25 basis points. This was a price adjustment, not a quantity expansion. It changes the cost of short-term funding, not the amount of money in the economy. So that's number 1. Number 2, the interest paid on bank reserves was also lowered. This helps keep the overnight rates aligned and prevents distortions in short-term markets. Again, this is rate control, not credit creation. Okay, so that's number 2. Number 3, short-term Treasury purchases were authorized conditionally. Okay, conditionally. Only short-duration securities, only if needed, and only to maintain system stability. This is not an attempt to push investors into risk assets. It's an attempt to keep the pipes from clogging. Okay? And this is why it's not QE. Quantitative easing has very specific characteristics. Those are large-scale purchases, long-duration assets, intentional downward pressure on long-term yields, and another one, explicit easing of financial conditions, right? None of those are present here. There is no broad expansion program. There is no long-term yield targeting at all. And there is no stated goal of inflating asset prices either. So it's just not true what's being said. This is not stimulus. This is stabilization. Okay, so what is the Fed really responding to? The decision is about funding mechanics, not economic optimism. The Fed is responding to tighter reserve conditions, sensitivity in short-term funding markets, the risk that small frictions turn into larger disruptions. This is a preventative move, not a any kind of exaggerated reaction to collapse. And importantly, it's happening inside an already existing framework, not outside of it. And lower policy rates do not automatically mean higher asset prices. Okay, markets care about expected growth. They care about risk premiums, earnings durability, funding reliability. A modest rate cut combined with reserve maintenance does not erase uncertainty, inflation pressures, or structural risks. This is not a risk-on signal. It's a keep the system steady signal. Okay, so let's ask the question as to why the money printer narrative keeps returning. And here's what I think, respectfully. I think because people collapse three very different things into one phrase. And that is, number one, central bank balance sheets. Number two, interest rate changes. And number three, credit creation in the private sector. Those are not the same thing. All three of those things are very different. And in today's system, banks are constrained by capital and risk. Lending decisions are private. Central banks manage conditions, not spending decisions. So the idea that the Fed simply prints money and releases it into the economy, it no longer reflects reality. If it ever truly did. So, just clearing the air here. The Fed did not panic, and it did not restart quantitative easing. And the Fed did not turn on money printers. What it did was make sure the system continues to function without stress, quietly, and deliberately, and with very narrow tools. And, that may not be dramatic or exciting or a headline, but it is how modern monetary systems actually operate. I want to thank you for listening to Special Edition 5 of the Global Ledger. I wanted to do this episode because of the large amounts of headlines that I'm seeing about this, and that's a scary thing to say, especially when your dollar is so important to you. And so I just think that if understanding what's really going on, just remove any of the fears or conspiratorial, just clearing all of that for a second and just looking at the mechanics, I think is extremely important. I wanted to kind of separate the headlines from the mechanics of the system and fear really from facts. So I hope this helped clarify what's really going on, and share it with someone who's worried about money printing. We'll break it down one system at a time. So we're going to continue on our main series for the next episode, but tune in next time for the next special edition. Once again, I'm Justin, and thanks for being here.